Hello federal employee friends, this is Cooper from Fed Retirement Planning back again, and I'm actually in my home office, newly established home office. You can check out my beautiful array of books. But the topic I want to talk about today is about something that everybody fears, especially those that are in the TSP, and that is a market correction. And I want to tell you some things to look out for here in the near term future relating to a market correction, a downturn in your thrift savings plan. Let's do it. Okay, so everybody worries about the TSP or the market in general because the TSP is simply tied to the general market, so I'm just going to speak in those terms. But people are always concerned about the market taking a downturn, especially those that have PTSD from 2008. In 2008, 2007, when we saw the housing crisis and we saw the market take a big gash, basically took a bite out of your retirement. Many people lost over 40%. I saw the iFund lost during that time around 42% in a single year. Okay, but just because we had that crazy, once in a century or, around there market correction, that doesn't mean that the next market correction is going to be that big, okay? There's oftentimes, these ups and downs of the market, but when we talk about a market correction, we're talking about a significant dip in the market. And that's kind of how the market just operates, okay? We run on these, 7 to 10 year cycles oftentimes. I wouldn't time those or say, every 7 years you need to hop out of the market. I don't think that's good investing principles, but it's something to watch out for, especially due to a lot of volatility that's happened in the market recently. You've probably seen on the news and things like that, a lot of, new records. The Dow's hit, 24,000, these big events that people, look to and the news likes to play up as they do everything because drama sells.
I am buying the market right here, right now, because I know more than anybody.
But just because the market's doing well now doesn't mean it will always do well. And I like a quote from Warren Buffett. He often says this. He says, when others are greedy, you should be fearful, and when others are fearful, you should be greedy. And so oftentimes I don't think I base my life upon that, my investing life, but I keep that in the back of my mind when I'm making investments. And right now, there's quite a few people that are greedy, at least that I would see out in the market. Now, what brought this about is Vanguard Group, who has many of the funds. I talk about their funds, and many people that move their money from outside the TSP into an IRA, they'll oftentimes go into a Vanguard fund due to their low fees. Not as low as the TSP, by the way. But the Vanguard Group, they're an honest company, and they come out with these different things, basically rating how the market's doing. And they came out recently and said that the chance of a stock market correction, okay, stock market correction, your TSP is in the stock market, is currently at 70%, okay? They're saying that there's a 70% chance that in the near-term future that a market correction is going to occur. And here's an interesting fact. Bank of America wrote in a recent note that the current bull market will be the longest in history if it continues until August 22nd, 2018. So if this market, the one that we're in, continues for about, 8 more months or so, then it's going to be the longest in history. And if we look at the outperformance of stocks versus bonds, if we wait until that August time period, the way that stocks have outperformed bonds would be the largest or the longest streak since 1929, which, as many of you know, was the Great Depression or the start of the Great Depression. Okay, so what should you do with the information? Because that's what you're wondering. You're like, Cooper, you gave me some great stuff. I'm glad you brought this to my attention, but what do I do with it? Because there's no point in me really talking about this unless I give you some ideas for what to do. Okay, first off, I can't give you an exact thing to do. As you know, I don't give out these blanket statements like, a lot of other financial experts because I just don't like them. There's no reason for me to say everybody should go into the F fund because it's a bond fund, and if the market does bad, then you'll be safe from the market correction in the stock market. Okay, although that would be a great thing and that would probably increase my viewership and everything like that, I'm not trying to, just grow this for no reason. I really want to help people. So I'm not just going to say everyone should do that. Now, is that something that some people should do? Probably, okay? Probably some of you should do that. Should everybody do that? No. Okay, so that's one thing you could do, is you could go into the F fund or go into the F fund, the G fund, or maybe coming out of maybe the S fund or some of those more volatile funds that are available in the TSP. Okay, you could also continue to diversify. If the US market does bad, yes, it's going to affect the international market because, you know, the US market is so large and it impacts so many others. But that said, if you go into the I fund, you may have a little bit more protection there. Maybe, who knows? I mean, the market correction is one of those things that we can't predict. Market timing is not something that you should necessarily do. So for the majority of you, because we don't know how much it's going to correct, and just because it corrects, that doesn't mean it's going to be a bear market. I would probably suggest just keep doing what you're doing if you're investing according to some of the things I've talked about in the past. Okay, many of you can just continue to invest how you're investing, and yeah, the market will correct itself, but we don't know when that's going to happen. We don't know how much that's going to happen or how much it's going to change. So because of that, you may be kind of foolish to change what you're doing now, because, you know, you could be, say, out of the market and in the G or F fund, which haven't performed all that well for a period of time, and then when the market bounces back, you won't necessarily know when to go back. So you may just be better off riding these waves as they come, especially if you've got a long time duration before you retire. The younger you are, the more volatile you can take. The closer to retirement you get, for most people at least, you should be pulling back and going more conservative, because let's say you have a year left before you retire and you plan to use that TSP to supplement your income, and there's a 40% correction. You're probably going to have to work for quite a bit longer to earn that back. And I don't want you to do that, okay? But these have just been some of my thoughts on the topic. Thanks for watching. Go ahead and subscribe if you haven't. I'm sure you'll enjoy the rest of the videos. I appreciate you watching. Leave me a comment or something like that. Tell me if you like any of these books in the background. I'll talk to you later. See ya.